Good morning. My name is Jim Doyle from Guardian Wealth, and on behalf of Jim Power and myself, I would like to welcome you to this morning's webinar. And Jim shall be on in just a minute to talk about the coronavirus impact. And just to let you know, we're definitely maximum 40 minutes here this morning. Before Jim comes on, I will give you a short introduction to Guardian Wealth. When Jim is finished, we shall have a short Q&A and then a close. We will issue out a certificate of attendance for your attendance at today's webinar, and we shall have that out to you today by email. So, to introduce Guardian Wealth, we were formed in 2005. The two leaders in Guardian Wealth are myself, Jim Doyle, and my colleague, Michael Coburn. I am an accountant by background, and I did have an accountancy practice called RDA Accountants, which I founded in 2002. I exited that business 2 years ago. I sold my 50% share in that business, and so that I could focus on Guardian Wealth and focus on looking after business owners from a pension and tax planning and financial planning point of view. So yes, we are very specialist pension and financial planners for business owners. Because we're from an accountancy background and a tax background, we are very comfortable with technical questions around the whole pension area and even around the whole tax area. And because of that, we get a lot of accountants who ask us questions, technical questions around pensions and tax, which we are quite happy to answer. We are advising clients on funds in the region of 100 million. So we are very well. We're quite a secure operation. You can see that we have offices in Dublin and Wexford, and our geographic area is Dublin, all along the East Coast, the Midlands and the Southeast. Just to let you know that we are going to be running a series of webinars. We have another webinar planned on the 12th of August, and as you can see, it's to do with wealth extraction for company directors, everything to do with tax planning opportunities around pensions. That will be delivered by my colleague, Michael Coburn. We're doing this because, of course, we are seeking to build closer relationships with accountants, and we're also doing it as a thank you to accountants for the referrals that we receive from accountants that we're very happy to receive. So I'm going to move over to Jim Power. Jim doesn't really need any introduction from me. He's one of Ireland's foremost and respected economists. So over to you, Jim.
Okay, thank you very much, Jim. Good morning, ladies and gentlemen. Welcome to the webinar. I'm delighted to be doing this webinar on behalf of Guardian Wealth. I have known Jim Doyle for a number of years at this stage, and we've presented together on numerous occasions over the last 15 years, I think. I would also, I suppose, stress that, and this will keep coming through, I hope, in my presentation, the really, really uncertain circumstances in which we find ourselves at the moment from both an economic perspective and from an investment perspective. So I think it goes without saying that for investors, having strong independent financial advice at a time like this, at a time of this sort of uncertainty, is absolutely invaluable and essential. So I think it's great to see Jim and Michael and Guardian Wealth holding a webinar like this morning, which hopefully will help you in your business planning and your business decisions. Over the next 25 minutes or so, I'm going to do a couple of things. One, I'm going to look at the global economic backdrop, what's happening there, because obviously for Ireland as a small open economy, the health of the world economy is incredibly important. I'm going to say a little bit about what's happening on investment markets, and then I'm going to wrap up by taking a look at what's happening in the Irish economy, and I suppose more importantly, the prospects for economic recovery. Suffice to say that COVID-19, has represented an absolutely massive shock to the global economy. There is no doubt about that. The impact on global health that it continues to have, the impact on global economic activity that it continues to have, and I think the impact on people's well-being, sense of confidence, and of course on the employment front has been pretty catastrophic. And I suppose one of the problems with COVID-19 is that coming into 2020, the world economy was already in a bit of a fragile place. Last year we saw a significant slowdown in the Eurozone economy particularly, but we also saw Asia, the United States, Japan lose momentum. So world economy was a little bit fragile pre-COVID-19, and obviously COVID-19 has totally exacerbated that situation. And quite simply, it doesn't go without saying that, or it goes without saying that when an economy is forced to shut down or large swathes of it, the impact on activity and everything else is pretty catastrophic. The International Monetary Fund has reckoned that this year will see the sharpest slowdown in global growth since the 1920s. The OECD has described it as a global health crisis without precedent. And I think the OECD really sums it up by saying that the economic outlook at this juncture is exceptionally uncertain. That is a little bit of an understatement, because the problem is, the world economy, or large swathes of it, were shut down from early March onwards. But over the last couple of months, we've started to see a gradual opening up of the world economy. But of course, the problem is that as the global economy is being opened up, we are getting further outbreaks of the virus. And I think the United States at the moment, and Donald Trump overnight would have, I think, admitted this at last, that the US is in a bit of a crisis situation at the moment. And this really is the challenge. Until a safe and effective vaccine is delivered, policymakers will walk a very, very dangerous, narrow tightrope, because on the one hand, they will be trying to preserve the health of the nation, and on the other hand, they will be trying to preserve and help the health of the economy, because you can't have one without the other. But they're not mutually exclusive, in the sense that the faster you open up, the greater the risk you have to further outbreaks of the virus. So it's a very, very difficult balancing act that policymakers are currently trying to grapple with. And I'm loath to criticize too many policymakers around the world for the way they're approaching this, because since March, this definitely has been, without precedent. We had no idea how the thing was going to evolve. We didn't understand the virus, so it was always going to be very difficult. And I do think that the last time we had a deep economic crisis of this magnitude was 2007, 2008. There are significant differences this time. This time it is not caused by a collapse in the global banking system. And I think more importantly, this time compared to 10 or 12 years ago, we're seeing a much stronger, much more coordinated global policy response to the crisis. Interest rates have been slashed. Quantitative easing, or bond buying, is proceeding at a massive pace everywhere. So central banks are pumping trillions of euros and dollars into the global financial system. And the other point that is really important is that governments are spending lots of money at the moment. They're running big budget deficits to try and address the problem. Over the next few days, we're going to see the Irish stimulus plan being launched. Yesterday, we saw agreement at an EU level of a 750 billion euro package to try and help the Eurozone economy. And I think most importantly this time around, the financial system is still functioning. We're not in a banking crisis, which is very, very important. So while the magnitude of the slowdown is dramatic, I'd be much, much more impressed this time with how policymakers are dealing with it. But of course, the big challenge is, opening up and risking secondary outbreaks of the virus. It's interesting that, well, I find it interesting at least that over the last few months, you know, when we're trying to gauge the real impact on the world economy, you know, there's been a lack of reliable economic data, because economic data by its very nature is a little bit historical and backward looking. So we've had the evolution of this new way of looking at economies called high frequency data. It's basically trying to measure stuff that's happening on a day-to-day basis. Mobile phone technology is a key player here. Footfall on streets, into shops, the movement of people, the movement of traffic, this sort of stuff is being monitored. And all of those high frequency data have been suggesting, you know, that the global economy bottomed out April, May, and that since then we've started to see a bounce back. The real economic data releases are now starting to reflect that fact, albeit they are a little bit historic, as I say. So the world economy is improving. The economic impact, as I said in my opening slide, has been dramatic. The peak to trough decline has varied enormously across different countries. And really, there's two things that determine the economic impact, really. One is how quickly and aggressively governments shut down their countries. So those that shut down quickly initially experience the sharpest slowdown in growth, but you would expect them to experience the sharpest rebound in activity as they open up. The second thing, and this is probably more important, is the sectoral makeup of economies is really important. For economies where tourism, car production, retail and leisure activities, personal services are very important, the impact has been very severe. Whereas for economies where IT, financial services, agri-food, pharma are important, the impact has been smaller. So you see varying degrees of economic pain around the world. And if you want to apply that to an Irish situation, you would say, for example, that County Cork is much more insulated from this than County Kerry, because Cork has a huge pharma cluster, whereas Kerry is heavily dependent on tourism. So the sectoral makeup is very important. And for the southeast, where I'm from, the Waterford part of it, you know, where tourism is incredibly important, you know, the economic hit is quite significant. Moving on to, try to move on here. Sorry, it's not moving for me. Sorry, my slide isn't moving for some reason. Moved too quickly then. Okay, sorry about that. So where the risk to the global economy, you know, obviously the biggest risk is of a secondary outbreak, and we're starting to see that happen. You would hope that this time around the ability to deal with secondary outbreaks will be better than it was the first outbreak back in March, because we now understand the virus a little bit better. We understand what works, what doesn't work. So I think what we're going to see going forward really is, as there are outbreaks, bits of economies will be shut down again. So we saw Leicester in the UK, for example, northern Germany, northern Spain. That's going to be the way of it, unfortunately, until a vaccine is delivered. One of the issues, I suppose, from a global economy perspective, and this is really important for Ireland. Prior to COVID-19, over the last few years, we've seen this move towards nationalism, anti-free trade, the growth of protectionism. Brexit was an example of that. The election of Donald Trump and his trade dispute with China, the rise of Orban in Hungary, all of these things fly in the face of globalization and free trade, which is so important to Ireland. So you would really hope that at the end of all of this, that there will not be more stringent restrictions on the movement of goods, people, services across countries. So certainly it's a risk that we will get greater fragmentation out of this. Trump is in big trouble, there's no doubt about that. And what worries me more than anything else about that fact is that what he might be capable of doing ahead of the election in November to try and close the opinion poll leads with Joe Biden. So watching Trump, and we're already seeing him picking rows with China and the European Union on an ongoing basis. I think it's important, as I said in my introduction, the global financial system is still working. It is really important that that continues to be the case, because the last thing you want are companies and individual households starting to default on debt, and that then starts to feed into a bad debt problem for a fragile banking system globally. And that's why it is so important that there's strong intervention to help the cash flow of businesses, to help the cash flow of households, to prevent a debt crisis from emerging. Brexit is still on the agenda. Britain leaves the transition mechanism on the 31st of December this year. The following morning, the 1st of January next, the new regime, whatever that will be, applies. To date, the EU and the Brits have not agreed a trade deal, and if they fail to agree one, come the 1st of January next, the world will fundamentally change for all of us. World Trade Organization trade tariffs and restrictions will apply. And for Ireland, that is a particular issue. And it's important that the EU this week put in place a €5 billion package to help countries and sectors that are most adversely affected by Brexit. And I think Ireland logically should get the bulk of that money in the event of a hard Brexit. I feel at the end of the day, and this is a gut instinct rather than a scientific forecast, that a deal will be done over the next 2 or 3 months to avoid a crash out. It'll be a watered down compromise, but avoiding a WTO scenario next January is incredibly important. So in a nutshell, I'm skipping through this quickly, uncertainty definitely is the catchphrase at the moment. It's the byword that is dominating everything. Moving on to the a little bit of a discussion on what's happening on financial markets. So the slides are just very slow in moving here. Okay, bond yields. I've looked at 10-year bond yields on the 6th of March at the beginning of this crisis, and again on the 17th of July, a few days ago. And what you see there, in most cases, 10-year bond yields today are lower than they were at the beginning of the crisis. That doesn't make logical sense, because I can assure you bond yields in countries like Ireland, Italy, Greece, Spain particularly should be significantly higher. But this is what quantitative easing is all about. It is buying bonds, keeping bond yields down so that governments can borrow cheaply to fund the big deficits they're going to have to run over the coming years. That is the purpose of quantitative easing, and that is why both official interest rates and bond yields will remain at historically low levels for the foreseeable future. That is essential for at least the next couple of years. On the equity market front, it's been an interesting story, really. Back in after the great crash of 2007, 2008, in the first week of March 2009, global equity markets bottomed out. And despite all of the economic difficulties, banking crises, Greece, Ireland, etc., between March 2009 and the end of 2019, we saw tremendous gains in global equity markets, a fantastic environment for global equity market investors. Okay, the States did particularly well because Trump had a very aggressive corporate tax approach to help US corporations. The UK was one of the poor performers. That is Brexit related pretty much, and the rest did pretty well also. And now I look then at the second column there out on the right hand side is what markets have done between the 1st of January this year and the 17th of July, just a few days ago. And you can see there, okay, negative, the United States minus 2.2%, the UK a little bit more negative. I would describe those equity market performances as very, very impressive, given the circumstances that have prevailed since early March with COVID-19, the collapse in the global economy. So equity markets are definitely defying logic a little bit at the moment. And what I've done here is I've looked at where, after the global pandemic was declared in early March, global equity markets took a real hammering for a couple of weeks, but then they bottomed out. And in brackets there, you can see the dates on which markets bottomed out. Around the 18th to the 23rd of March, that period, markets bottomed out. And since then, And in fact, you could add another couple of percent to those gains up to this morning, because equity markets have had a good couple of days since I prepared this slide. But you can see there, you know, the S&P up 44%, the FTSE 25, Germany over 52, Japan 37, the Irish market up 37. So equity markets are coming back very strongly. There's two reasons for that, really. One is that markets believe there will be economic recovery over the next 12, 18 months. Secondly, and obviously the risk to that is a health risk rather than an economic risk. You know, significant outbreaks of the virus would damage that. And the second point is that in an environment where official interest rates and bond yields are going to remain virtually zero or in negative territory in many cases, there is nothing else to do with money at the moment. So investment flows around the world are just going into equity markets. As an economist, I'd be slightly concerned about all of that, but the markets are doing what the markets are doing at the moment. So I think it is really important that if you are a nervous equity market investor, be it your pension or direct investments, you should really talk to Jim and Michael about, you know, understanding what your parameters should be at a time like this. You know, it's important to understand your tolerance for risk, the time frame of your investment, whether you're short term or long term. All of those things you will get from a financial advisor, an independent financial advisor, and they're really important at a time of uncertainty like this. Moving on to the Irish economic situation. Sorry, I should have said in my introduction also, there will be an opportunity, if I ever shut up, to ask a few questions at the end of this, okay? So if there's anything I've skipped through too quickly or you disagree with, please let me know. In the case of Ireland, we've seen a dramatic decline in economic activity since early March. There is no other way of sugarcoating that. No surprises there, because large parts of our economy from the middle of March onwards were effectively shut down. And that's a pretty unprecedented situation, because normally in recessions, you know, demand slows down, business slows, but businesses remain functioning as long as they can. Whereas this time we just got perfectly viable businesses being forced to shut their doors. The Irish government and the EU is allowing this, is accepting much higher budget deficits over the next couple of years. I have no doubt whatsoever about this, that government will have to spend a lot of money supporting businesses through this process, not just to get businesses reopened, but to ensure that businesses survive more difficult conditions for the next 12, 18 months. Because, you know, for retailers, for hospitality businesses particularly, business volumes are going to be restricted and costs higher because of health protocols, social distancing, consumer caution, all of those things. So it is really important that government borrows and supports businesses now and for the foreseeable future. Fiscal austerity cannot follow this. There is no way we accept over the next couple of years any increases in taxes or cuts in government spending to try and reduce the deficit. That would risk turning a recession into a depression. So it's really important that we accept we're going to have bigger deficits for a couple of years. We will have a bigger level of government debt, but that is the price that will have to be paid for getting the economy back functioning again. Because at the end of the day, the only way we will address our debt problem is through economic growth. I think there is no doubt whatsoever about that. Strong support, as I say, for business will be required for a prolonged period. Thankfully, the ability of the Irish government to borrow to fund these deficits is very strong because of past decisions. And I would take you back to 10 or 12 years ago, where we were hearing on the Vincent Brown show every night various people arguing that we should default on our debt, that this was the best way out for Ireland. If we had defaulted on our debt back then, our ability to borrow today to deal with this crisis would be hugely restricted. So thankfully, our credit rating is good. We can borrow very cheaply as much as we want to. That is important. And let's recognize also that this discussion we're having here about deficits and debt and so on, this is not unique to Ireland. Every country in the world is having this discussion at the moment because they recognize keeping businesses going is absolutely essential to re-employ workers, to get society and economies functioning again. Another feature we've seen in the last while is that there's been a significant increase in personal savings. And I know Q1 only includes a month of COVID-19 really, but during Q1, there was a 2.4 billion increase in personal savings. And I'm led to believe that in the month of April, personal savings increased by another 3 billion. So at the end of March, we had 106 billion in personal savings, and they have subsequently increased beyond that, probably around 110 billion at the moment. That money is precautionary. It will come back into the system as soon as people have the ability to spend, have the confidence to spend. So, you know, that is, I think, an important facet of the recovery story. But when you talk about recovery, you know, the big caveat here is all of the conditions are in place for economic recovery, other than concerns about further outbreaks of the virus requiring further lockdown of economies. You know, that's obviously the big risk factor, and we will not be able to rest easily until a vaccine, a safe and effective vaccine is, excuse me, is delivered. This is probably a dreadful slide, okay, and Jim, I'm quite happy to have these slides sent out to everyone who participated this morning, okay, if they're interested, okay, but it's just a snapshot of the most up-to-date data. And I never actually believed in my wildest dreams I would be commenting on slides and figures like this. You know, retail sales in May were 26.6% down on a year earlier. But during the month of May, they actually increased by 29.5%. So that 26.6 is a year-on-year comparison. But since the economy started to reopen, consumer spending is coming back into the system. But obviously, business conditions are restricted by social distancing and so on. The export side of the economy is doing well. Chemical and pharma, which accounts for almost 66% of our exports, growth of 11.3%. That multinational presence in Ireland is really, really important anchor at a time like this. For the motor industry, very difficult environment. For tourism, a very difficult environment. One final point I would make is that there's been a massive deterioration in the public finances because government has been spending massive amounts of money on health and social welfare. One thing that is holding up well, corporation tax is holding up really well. Secondly, income tax in the circumstances is holding up well. Given how many people have been on unemployment benefit, you might have expected a much more significant decline in income tax. But the reality is that a lot of those workers who have lost their jobs are lower paid. They don't pay that much income tax in any event. Whereas a lot of workers, the bulk of workers who pay income tax actually have survived during this crisis, working from home, etc. But you know, there's a large part of the economy still doing well. This is the collapse in consumer confidence. No surprises. You can see on the extreme right-hand side, it is starting to bounce back. This is a breakdown of the export performance in the first 5 months. And I just stress the point that the chemical and pharma bit is really, really important in a situation like this. Looking at the recovery issues here, and I'll skip through. I realize I'm up against the clock, Jim, okay? So I'll skip through this pretty quickly. Economy reopening since the end of May, which is good. Secondary outbreak and further lockdown, those are the risks, as I keep saying. Consumers have not lost the spending habit. You know, when people have the ability and the confidence to go out there and spend, those savings will come back into the economy. Our foreign direct investment base, very strong, as I've said. The agri sector is strong, but it's a challenging environment for agri-food companies as well, because while the supermarket sales of food were very strong, the food services side of the business died, with restaurants, hotels, pubs, canteens all shutting down. that is now starting to come back. The prospects for international tourism, very challenging. You know, when you look at the green list that was published last night, you realize just the mess there is for the whole tourism sector at the moment, and it's hard to see that dissipating anytime soon. Stimulus plan will be announced over the next couple of days. I think it was due to be this afternoon, but I don't think it's happening. COVID-19 support will be essential for the next 19 months. You know, there's no doubt about that. Keep your eye on Brexit and the negotiations over the next 2 or 3 months, because the risks for Brexit and the Irish economy are still very, very real. Hopefully, logic and sanity will eventually prevail. My final slide, you know, we will be left with a massive debt legacy after all of this. We have to accept that, as will every country in the world virtually. Social distancing protocols will apply until a vaccine is developed. That's going to challenge business. I spoke about the growth of economic nationalism, and for a small open economy like Ireland, that is something we really need to watch. The migration to online, you know, is a feature, and for any consumer-facing business, it should now be very obvious that having a strong online presence is really, really important. Remote working has become a feature of the landscape. For some, it's very acceptable, but for the majority of people, I think what they really want is to get back into the office as quickly as possible. But definitely, I think for all employers, there will be a much more flexible approach to be adopted with employees to suit different requirements, because employers and people now realize actually that working from home does work in many situations. So I spoke to one employer in the last few days, 60 people, who basically said that he is going to have to sit down and negotiate 60 employment contracts with all of his workers at the moment to try and accommodate their different requirements. Re-employment of workers is absolutely essential. You know, that's why the business support is so important. So my final point would be, you know, at the end of February, the future for Ireland looked very, very bright. We were doing well. And with COVID-19, it's now shrouded in deep uncertainty. But we are not unique. And, you know, the question will be really surviving, keeping businesses going, economies going, until a safe and effective vaccine is actually delivered is incredibly important. That's my time up. I think I went a couple of minutes over. Apologize for that. I'd be delighted to take any questions or comments you might have at this stage.
So if anybody has questions, please type them in. And we have just a couple of minutes, 3 minutes. I do have one question in so far, Jim, and it's very simple. It asks the question, what's the impact of all of this likely to be on my pension? Now, do you want to take an initial stab at that, or is it more for me?
Well, I'll take an initial stab and then I'll hand over to you, Jim. I mean, the bottom line actually, as I showed there, you know, pensions have actually held up very well during this crisis, I think in most cases, because equity markets actually have totally surpassed what might have been expected in the circumstances. So the impact on pensions has been nothing like as damaging as was the case back in 2007, 2008. And I'll delve into Jim's territory at this stage by saying that you really do need to talk to your pension provider, your financial advisor, to find out exactly where your pension is invested and to understand, you know, personally, okay, and this is my personal perspective, I have no intention of retiring for the foreseeable future. So I have, I'm quite happy to have the bulk of my pension still in equities. Equities are riskier, but they longer term, they deliver better returns. Whereas if I was contemplating retirement in the next 12 months, I'd be a little bit concerned about my risk profile at the moment. Jim, I'll hand back to you on that.
Thank you, Jim. Yes, first of all, everything that you've said, Jim, I would concur with, including the point you made in your presentation when it comes to stock markets and pensions. what we are finding and the way that we're treating the situation is that we expect further volatility in the future, and we're advising our own clients in accordance with that sort of an attitude. So it does very much depend on their time span. If they have a long time span before they need to access the money, yes, we're prepared to advise to continue exposure to stock markets. But it is a case by case and an individual by individual situation. We have certainly found in the last 2-3 months that we are spending most of our time talking to our clients and keeping a close eye on the performance of their individual pensions and monitoring them very, very carefully with reference to their own situation and their own views, and making sure that they're not overexposed at the moment. Another point on that is that we are finding a very big difference between different pension companies from a performance point of view, particularly with reference to how they have reacted to the coronavirus fall in stock markets and how they have responded since stock markets have risen from that fall. So a huge difference in behavior for different pensions, even different pensions with the same risk profile from different companies are behaving very, very differently. So it's important to benchmark what you have and to keep a close eye on it. So yes, we expect more volatility, and while this uncertainty and virus is still around, we're being very careful and keeping very, very close eye. So we are at 11:41. So I would like to thank Jim Power and thank all of the attendees. Thank you so much.